In this class, we are attempting ABWA March 2019 question 2. ABWA is accounting bodies in West Africa, also called ATSWA. Remember, you can visit jadosconsulting.com to take the class that covers the topic you're solving. And then don't forget that you can always order for my study bag or my textbook, okay? You can reach me on the number displayed or pay into the account displayed. So here we have question 2, ABWA, March 2019. The trial balance of Makeup Enterprises as at 31st December 2018 failed to agree. A suspense account was opened for the difference. Draft final accounts were prepared that revealed a net profit of 80,000 Liberian dollars. Okay, for the year ended at 2018, the following errors were subsequently discovered. So we have first, 1 year, the purchase day book total of 160,000 Liberian dollars has been posted to the ledger as 320,000 Liberian dollars. 2, we have the sales account has been undercast by 240,000 Liberian dollars. 3, discount received of 14,000 Liberian dollars had been debited to discount allowed account. 4, an accrued salaries and wages of 12,000 Liberian dollars was omitted. 5, loose tools bought for 8,000 Liberian dollars has been debited to purchases account. 6, purchase of inventory for 140,000 Liberian dollars had not been posted to the ledger. 7, bad debt of 19,000 Liberian dollars written off in the trade receivables account had not been treated in the expense account. And then we have 8, the proprietor had withdrawn goods that cost 6,000 Liberian dollars for personal use. No entry had been made in the books. You're required to prepare A, the journal entries to correct the errors. B, the suspense account and show the difference in the books. C, a statement to show the correct net profit for the year. So basically, this is actually a question on errors. We have errors that usually come up while preparing or entering transactions into various ledgers, and then errors that can affect the trial balance, errors that might not affect the trial balance, and then usually we prepare accounts, and then sometimes when we prepare the trial balance, there are issues. It can agree with errors, it might not agree, and that means there are errors as well. So the ones that affect the trial balance are what we call errors affecting the trial balance. That means the trial balance will not agree. And then the ones that will not affect the trial balance are errors not affecting the trial balance. That means trial balance will agree, but you still have some errors. And then basically in this question, you can actually go to jadosconsulting.com to take the classes on errors, because here I can see errors, I can see suspense account, I can see your normal double entry principles here. Okay, I can see your balances for what asset items, liability items, expense items, income items. Because you need all that here to fare well in this test. So go to jadosconsulting.com to take the classes. So basically here they asked us to prepare journal entries to correct the error. But quickly remember that your suspense account comes into play where the trial balance refused to agree. So let's say, for instance, this is your trial balance, okay? So your trial balance, you have the debit, and then you have your credit. So at the end of the day, we expect that whatever you have here should be equal to what you have here. So if at the end of the day, you have 10 here as total, we expect to have 10 here as total. But it is possible that you can have 10 as total in the debit side, and then you have 8 as total in the credit side. In this case, you say the trial balance is not agreeing. So that means there's an error that's affecting the trial balance. So before you even begin what we call investigation to know the difference, usually it's expected that you open the suspense account to temporarily agree the trial balance. So usually we just open suspense, we put 2 there so that it becomes 10. Okay, so I'm saying if, for instance, what you had here is 8 and what you had here is 10. So 10 plus 10 is 10, but here is 8. So because of the difference, which is 2 here, and because we want to temporarily agree the trial balance, we put the 2 in the credit side. So here in the suspense account, we say trial balance difference of 2. Okay, and then we'll now go and what? Investigate, discover the errors, raise journals to correct the errors, and then close our what? Suspense. So that is what happens where you have a suspense account. So basically, I expect you to go to the janosconsulting.com to take free classes on errors, free classes on trial balance, free classes on double entry. In fact, all the classes, including exercises on janosconsulting.com, is what? Free. So if you've learnt or you've gained knowledge, you can as well support the course by your free will donation. So here we have what they call it, makeup enterprise. So let's go. We have makeup enterprises. Okay, makeup enterprises. So that's the name of the business. And then the first thing was prepare was journal entries. So we say journal entry. So what do we have here? You can have, what do you have here now? So let's call this our what? Descriptions. So let's call this debits. Okay, and then let's call this what? Credit. Remember, it's what? Sierra Leonean, sorry, Liberian dollars, please. Okay, so the first error there says what? The purchase day book total of 160,000 Liberian dollar had been posted to the ledger as 320,000 Liberian dollars. Okay, now remember your purchase is a cost or an expense, so it's not a debit balance. Okay, so let's test it here. So we have purchases. This is an expense, that is debit balance. So usually your purchases day book, you transfer to the debit side of your purchases. Okay, now they are saying that the total is 160, but they posted it as 320,000. So they have written 320,000 here. But what ought to be written here is what? 160,000. So it means that we need to reduce this by what? 320 minus 1, that's still 160. Okay? So 320 minus 160 is 160. So that means this purchases has been what? Overstated by 160 what? Thousand. So how do we correct this? We credit. So if you credit this, so that means that by the time you balance up, okay, you will now be having, okay, you'll be having your what? Your 160 correctly standing or sitting where? In the debit side. So this is just a way to test how to correct the error. But the entry we have made to make the correction is this 160 that we credited in the what? Purchases account. But remember that every credit entry based on double entry principle must have a corresponding what? Debit entry. Every debit entry must have a corresponding credit entry. And in errors, where you cannot identify the corresponding account, you take it to suspense. So that means that if you narrate or if you try to interpret the error question or the error identified, and then you can only identify one account that is affected, and the only way to correct that account is to either debit or credit. So if you're crediting as what? A correction entry, there must be a corresponding debit entry. So if there is no account in the interpretation to take the corresponding debit entry, then you take it to where? Suspense. So in this interpretation now, the only way we could correct this overstatement is to credit purchases what? With 160,000. So where do we take the corresponding debit entry to? The question or the investigation revealed that only purchases account was affected. So the corresponding entry will go to where? Suspense account. So you have credited purchases. What do? You debit what? Suspense with 160. So we can just say suspense purchases. So this is the entry. Okay? But now we use a journal to do that. That's why we're going to prepare the journal. So I have a journal here now. What did we debit? We debited suspense. So we say what? Suspense debited with how much? $160,000 Liberian dollar. Okay, and then you now say purchases credited with how much? 160,000 Liberian dollar. Okay, so what do? You narrate. Being correction of what? Over statements of what? Purchases. That's it. Okay, so every entry has what? A narration. Okay, so this is the first one. So the second question there said, well, the sales account has been undercast by 240. So what is undercast? Undercast means that what? You have entered below the original amount. Okay, sales account has been what? Undercast by 240,000 Liberian dollar. So let's test it. Okay, let's test it. So we have sales. Sales is an income. That's the credit balance. Okay, so they say it has been what? Undercast by 240,000. So what is the original value? We don't know the original value. So let's assume the original value. Let's assume that original value is 300,000. This is the original value we are assuming. Now they are saying that it has been what? Undercasted by 240. That means that what? They have reduced the 300,000 by 240. So that means they've entered how much? 60,000 Liberian dollars. So it means that you have understated sales by how much? 240. So if sales has a credit balance, so how do you correct this? You credit it with the what? Undercasted amount. So that means you are going to say 240,000 Liberian dollars, so that you can get the original amount of $300,000. So the correction error there is this 240 entry. So where is the corresponding entry? The question or the investigator did not review that. So there's no corresponding account that can take. So take to where? Suspense. So you're going to say suspense 240,000. So here it's suspense. Here is what? Sales. So we come here. What did we debit? We debited suspense. Oh, how much? That's 240,000 Liberian dollars. So credited what? Sales. 240,000. Okay, so you do the narration. It's just grammar. Speak the grammar there. So the next one there, third, say discount received of 14,000 Liberian dollars has been debited to discount allowed account. So how do we interpret that investigation or that error? So we have discount what received. Discount received is an income, so it's a credit balance. Okay, discount received of $14,000 has been debited to discount allowed account. So we have discount what allowed. Discount allowed is an expense, debit balance. So discount received ordinarily is a credit balance, but they now say they debited it to discount allowed. So discount allowed is taking 14,000 as an expense, but it's an income of 14,000. First thing first, the income account did not even receive anything. So they now took it to what? An expense account. So let's correct the income account first. Discount received of $14,000. So discount received is an income. Incomes are credited. Go and check your what? Ledger balances and the rules. It's on jadosconsulting.com. So discount received here should be credited with how much? $14,000. Okay? But we have credited discount received. Now, what we cannot debit discount allowed again because there's already an error there. So we take it to where? Suspense. So we have suspense for discount received. So we have discount received for suspense. How much? 14,000. So this is the first correction. This can't allowed here now is an expense, taking an amount of money that's not supposed to be there at all. So we need to cancel out this can't allowed. How do you cancel it out? You credit it. 14,000. So we say suspense. So here we say discount allowed. How much? 14,000. You see? So we've cancelled that discount allowed. We've taken the value to where it belongs to. So the first thing we did there was that what? We debited suspense with how much? 14,000 Liberian dollars. Credited discount what? Received with how much? 14,000 Liberian dollars. You can do your narration. It's just grammar. Speak your grammar there. The next one we did, we debited suspense with how much? 14,000 Liberian dollars and what? Credited discount what? Allowed with 14,000 Liberian what? Dollars. So you can go ahead and do your what? Narration. It's just grammar. The next one there, accrued salaries and wages of $12,000 was omitted. Remember, there's a difference between accrued expense and expense. An expense is the expired cost for the period. Now, accrued expense is an outstanding cost that is yet to be settled but has been enjoyed for the period. So these are two different things. So they're not telling us that an accrued expense, okay, an accrued what? Expense, accrued salaries and wages of $12,000 was omitted. So there are two things there. We have salaries and what? Wages. This is an expense. Okay? And then we now have what? Accrued salaries and wages. This one is a liability. This is an expense. Okay? Now, this wages is an expense. They say it's accrued. That means that it is due to be what? Paid, but it has not been paid. So you have to make provision for it. Remember your adjustment to final account. You can go to jadosconsulting.com to take adjustment to final account. Okay, accrued expense at the end of the period are added to the expense. So basically, when you have accrued expenses, it's increasing the expense for the period. And expenses are debited. So what do? We say accrued what? Expense. How much is that? 12,000 Liberian dollars. So we have 12,000 Liberian dollars. There is a corresponding entry here. So what do we call it? Salaries and what? And wages, 12,000 Liberian dollars. So you see that in this investigation, we could identify the account to be debited and we could identify the account that should take the corresponding entry. So there will be no need for suspense here. Okay? So what do? We say salaries and what? Wages. How much is that? 12,000 Liberian dollars. They will now have what? Accrued what? Expense. 12,000 Liberian what? Dollars. So the next one there. Loose tools bought for 8,000 Liberian has been debited to purchases account. Remember that tools are assets. And remember that when you purchase asset items, you open the account for the asset item, not purchases. You only take, items bought to purchases where the item is what the business is dealing in. That is, the item is forming stock or inventory of the business. So what am I actually saying? So what I'm saying in essence is that whenever you are dealing in a particular product, for instance, if you deal in sugar or you deal in flour or you deal in bags, okay? So if you deal in bags, it is understandable that you're going to be purchasing to sell. Now the question is, if you purchase bags, are you dealing? Of course, that's purchases. But if you purchase furniture, for instance, okay, furniture is an asset, so that cannot be part of your what? Purchase. So that's the same thing here. They're saying that loose tools bought for $8,000 had been debited to purchase. That's an error. Okay? It's an error. So as a matter of fact, loose tools account is an asset account that you take that for transaction, but you've taken it to purchases. So what are we saying here? Let's try to interpret it. So we have loose tools, and then we have what? Purchases. So loose tools bought for $8,000 has been debited to purchases. So we have 8,000 here. This value here should be debited to loose tools, not purchases. It should be here, not here. So what do? We take it out by crediting purchases. Now after crediting, now you debit loose tools. So it means that we could identify the account to be credited and the account to be what? Debited. Okay, so no suspense. So you credit purchases, debit what? Loose tools. So let's go. What do we have here? We have loose tools of how much? 8,000 Liberian dollars. Then we now have purchases credited with how much? 8,000 Liberian dollars. So what's the next one there? Bad debt of $19,000 written off in the trade receivable account had not been treated in the expense account. What is bad debt? Bad debt represents expenses, or let's say bad debt represents debt that cannot be recovered. Someone is owing you 10,000 naira, paid you 8,000, the remaining 2,000 you follow, chase, and then you couldn't get. Okay, fine, let's forget it. That's bad debt. It means that you could not recover that debt. And usually when there's a bad debt, it increases the expense of the word business. So they are saying here that bad debt of 19,000 Liberian dollars written off in the trade, so that means it's taken off the receivables account, had not been treated in the expense account. So what's the issue here? The issue here is that the debtor's account has been what? Has been corrected, or has been entered, or has been revised, but the expense account was not taken into consideration. So we have bad debt. So if there's a bad debt, you credit the receivable account or the debtor's account and debit bad debt. So here we have 19,000. So you debit bad debt, 19 what? 1,000. But because it's only affecting bad debt, where would the corresponding entry go to? Suspense. So we have suspense, 19 what? 1,000. Okay? So this is what we did here. So let's take our journal entry here. Okay? So bad debt debited, suspense credited. So let's go. Journal here is, let's continue our journal here. Okay? Let's continue our journal here. So what do? We debited bad debts, okay, with how much? 19,000 Liberian dollars. Credited what? Suspense with 19,000 Liberian dollars. So you can do your narration there. So what's the next one there? The proprietor has withdrawn goods that cost $6,000 for personal use. No entry has been made in the books. Remember, drawings simply means taking product or cash for personal use. You own a business, okay? Usually you sell what you are dealing in, and you buy and then you sell. But instead of buying and selling, you actually took some for personal use. So what are we saying? That's drawings. Okay, so the proprietor here withdraw goods that cost 6,000 Liberian dollars for personal use. No entries have been made in the book. So usually when there's drawings, what do? Debit drawings and credit the inventory. So we have drawings here. We debited 6,000. Credit inventory, or what you call stock, with how much? 6,000. Okay, so what do? We say what? Drawings, how much? 6,000 Liberian dollars. Inventory or stock, 6,000 Liberian dollars. So it for the errors, but I can see that there's an error here that we omitted. Okay, we've done 1, 2, 3. Okay, error 6. Purchase of inventory for 140,000 Liberian dollars have not been posted in the ledger. Okay, So what am I seeing here? Purchase of inventory for 140,000 Liberian that has not been posted in the ledger. Now, there's a way to interpret, but I want us to understand that if they are said has not been posted in the ledgers, they will be asking, was it purchased in cash or was it purchased on credit? Okay, but here they said it has not been posted to the ledger, so it's just one ledger, which is inventory or purchases here. Okay, you know, your traditional opening stock, add purchases, less closing, they are all inventory. So, arriving at a cost of sale. So we have what? Purchase of inventory, 140,000. So if you make the purchases, okay, what do? You debit purchases and credit maybe cash if you're buying in cash, or credit the supplier if you're buying on credit. But now they're saying it has not been posted to, that means it has not been posted to purchases account. Okay, so we can say purchases or what? Inventory. So what do we have? We debit purchases here, 140,000 Liberian dollars. Okay, so because there's no corresponding entry to take the what? The credit. Where do we take it to now? We take it to where? Suspense. So what do we have? Purchases, 140,000 Liberian dollars. So let's come to our suspense here. So what did the first thing? Our journal here rather. So what did we do? We debited purchases. Okay. How much? 140,000 Liberian dollars, and then we credited what? Suspense, 140,000 Liberian dollars. So you can actually do the narration there. Okay, so that's it for the first part. You require to prepare journal entries to record the errors. So we have corrected the errors with the journal. So the next one said prepare suspense account. So let's prepare the suspense account. Okay, so let's say suspense account. Okay, so here is debit, here is what? Credit. So how do we do it? We come to our journal. If your suspense account is debited, you take it to debit side. If your suspense account is credited, take it to what? Credit side. So the first one here, we have suspense account is debited against what? Purchases. Abi? So we come to debit side, we say what? Purchases. How much? 160,000 Liberian dollars. The next one here, suspense is debited against what? Sales. So we come to debit side, we say what? Sales. How much? 240,000 Liberian dollars. The third one, suspense is debited against what? Discount received. Come to debit side. Say discount what? Received. How much is that? 14,000 Liberian dollars. The next one here, suspense is what? Debited, 14,000. Discount allowed, credited. So suspense is debited. We come here, we say discount what? Allowed. How much? 14,000. Here, salaries and wages debit, accrued expense credit. No suspense, so it will not go to suspense account. Here, loose tools debit, purchases credit, no suspense, move to suspense account. Here, bad debt debit, suspense, credit. So we'll come to credit side here, we'll say what? Bad debt, how much? 19,000. Here, drawings debit, inventory credit, no suspense, so no suspense account there. Here, purchases debit, suspense credit. So we'll come here, we'll say what? Purchases, okay? How much is that? 140,000. So ordinarily, if we were given the trial balance difference, it should have agreed without balancing. But here they didn't give us the trial balance difference. So the difference here will stand as the trial balance difference between the debit side and the what? Credit side. So let's go. Let's quickly add up. Okay? Let us add up. Let's add up. We have 160,000 plus 240,000 plus 14,000 plus 14,000. So what do we have there? 428,000. So you take out 19,000, take out 140,000. So 428 minus 19,000 minus 140,000. So what do we have? 269,000. So this is what we call the trial balance what? Difference. So both are now be equal to what? 428,000. So that is it for the suspense account. So the next thing there is a statement to show the correct net profit for the year. Remember that they had used the balances with errors, okay? They had used the balances with errors to prepare the statement of income and expenditure, or the comprehensive income account, okay? And then they have obtained the net profit. But that's before the investigation to review the errors. So that means that now that we have the investigation and we have reviewed the errors, and we have raised the journals, and then we have also prepared the suspense account, we need to what? Prepare a revised what? Statement of what? Profit. Okay? So what do we do? Let's prepare what we call statement of what? Revised what? Net profit. Okay? So here I'm going to do, I think it's Liberian dollar. Liberian dollar, sorry, Liberian dollars, Liberian what? Dollars. Okay? So here, additions. Here, subtractions. Okay? So basically, any item, okay, any item that requires an addition will come here. Any item that requires a subtraction will come here. Okay? So let's make it that simple. All right? So here, so reported net profit, according to the question, they said what? Draft final account of prepared that revealed a net profit of 80,000 Liberian dollars. So we have reported net about 80,000. Now, what you need to know is that your net profit is a function of your trading profit and loss income, trading profit and loss items, your sales, purchases, expense, and all that. So you have to know if the item will overstate, or if the item has overstated the profit or has understated it. If the item overstated the profit, it means that there's a need for a subtraction. If the item understated the profit, it means there's a need for what? An addition. So we have to understand that. So let's go to the journals. The first one here, we have purchases affected. Okay? So what did the error say? The error said the purchase day book total of one seat has been posted to the ledger as 320,000. That means that they have overstated purchases. So if you overstate purchases, you are going to overstate costs. If you overstate costs, it means you understate the profit. So if you overstate cost, it means you have understated profit. So how do you correct the profit now? You add. Okay? So we say what? Purchases over what? Stated. So we add. How much is that? 160,000. Okay? So that means that here is what? An addition. So what's the next one? We have suspense. We have sales. Sales will affect profit. So what is the error? The sales account was understated by 240. So if you understate sales, that means you understate income. If you understate income, it means you understate what? Profit. So that means that what? We need to what? Add to bring it. So we say what? Sales understated. How much is that? 240,000. So we are adding. Here we have suspense. Discount received here. What's the error? They said discount received of $14,000 had been debited to discount allowed. So that means that discount received is an income. Discount is an income. But because of the fact that it was not even recorded at all, it means that you have what? Understated the income. You see? So if you understate the income, you understate the profit. So how do you correct that? You add. Okay? So we have discount what? Received. How much? 14,000 Liberian dollars. So the next one, they said that what? Discount allowed here and suspense. So they said discount received of 14,000. Okay, was what? I can see discount received of $14,000 has been debited to discount allowed. So now that means that here the discount received was taken to discount allowed. So if you are taken to discount allowed, it means you have overstated the costs. So if you overstate costs, what will you do? You will what? Understate what? Profit. So how do you correct that? There has to be an addition. Okay? So we have discount what? Allowed. Of how much? 14,000. So we have 14,000. What's the next one there? They said what? Loose tools bought for $8,000 has been debited to purchase account. You see? So an account that is meant for tools, you took it to purchase account. So if you put it in purchase, that means you have what? Overstated purchase account, right? So if you overstate purchases, it means that what? You overstate costs, and that would understate profit. So what do? You correct by what? Adding. So we still have purchases overstated, right? How much is that? The question said use of $8,000. So we have $8,000. Okay. So what's the next one? We have salaries and wages of 12,000. Accrued expense. What do we have there? Accrued salaries and wages was omitted. Remember your accruals. What's your accruals there? What is your accruals? Okay? Your accrued expense, how do you adjust? You debit the expense that can credit your accrual, so that will increase your what? Expense. But they say it was what? Omitted. That means they did not even record it at all. Okay, so if it was omitted, it means the expense has been understated. So if the expense is understated, profit will be overstated. So how do you correct? You deduct, Abi? So we have salaries and what? Wages. How much is that? I can see, what's there? 8,000. So we have, 12,000. So we have 12,000. So that should be deducted. So the next one there, we have bad debt, 19,000. They said what? Bad debt written off in trade account had not been treated in the expense. They didn't treat it in the expense at all. That means that what? They have what? Understated the expense, and that will overstate the profit. So that will be corrected to deduct, Abi? So we have bad debt of how much? 19,000. So you deduct. What's the next one there? I can see purchases, right? Purchases of 140,000. What happened? They said the purchase of inventory of funds had not been posted to the ledger. That means you made purchase of how much? 140,000, and you did not post it to purchases account. So what happened? You had actually understated your what? Your cost, Abi. So if you understate your cost, you have what? What have you done? You have overstated your profit, Abi. So how do you correct that? You deduct. So they said what's that? Purchases of inventory had not been posted. They didn't post it at all. That means purchases was understated, cost is understated, profit will be overstated. So you deduct. So so we have purchases under what? Stated. How much? 140,000. So we deduct. Okay, so what's the next one there? Drawings. Drawings there. We have drawings of how much? 6,000 against inventory. Now, let me quickly explain something. You see, if you are in what they call an accounting software environment, maybe P3, also called Sage now, or Dark Easy, for instance, you know, there's the behind the scene entries. If you make purchases, what the system does is to what? To debit inventory and credit the vendor, as if it's on credit, or credit cash if you're paying by cash, or credit bank if you're paying by check. And then when you sell, what the system does is to what? Credit inventory with the cost of product, debit cost of sales, okay, and then credit sales with the sales amount, and then debit the what? Client if you're selling on credit, or debit cash if the person is paying in cash. So in an accounting software environment, you might not be doing the conventional opening stock, add purchases, less closing stock that we do manually, okay? But at the end of the day, if we look at the effect, if there were to be an error, okay, eventually it will eventually reduce, you know, drawings will eventually reduce the profit position, because usually you're going to say opening, you're going to say capital, add net profit, less drawings and all that, okay? But that is it from that perspective. I don't want to go too deep into that, we don't. But let's just follow our traditional opening stock, add purchases, less closing stock, okay? So now there is what they call drawings. The owner of business took product for himself, and they said that has been omitted. It means that if you have omitted that, it means that the stock you are going to be carrying as closing stock would have been what? Overstated. Okay? Would have been overstated. And when you overstate closing stock, remember it's opening stock, add purchases, less what? Less closing stock. So if you overstate your closing stock, it means that eventually you would have understated your what? Cost of sales. And that means that you would have overstated your what? Profit. So in order to correct that what? Inventory that was taken for personal use, that was not reported, we're going to what? Deduct it from the profit, because the effect on closing stock, I'm using closing stock now as, you know, as what has been affected. So we have closing inventory over what? Stated. Okay, if you overstate closing inventory, it means that you're going to understate your cost of sales. No, it's opening stock, add purchases, less closing stock. You understate your cost of sales. You understate your cost of sales, you are overstating your what? Profit. So what do? We deduct. So what's the inventory there? 6,000. Okay, so we have 6,000. So we deduct. So I think that's about it from the journal perspective here. So what do? So we're going to say what now? Revised net worth profit. So what do? You add up, you deduct. All the items in the bracket are deducted. The ones with that bracket are added. So we have 80,000 plus 160,000 plus 240,000 plus 14,000 plus 14,000 plus 8,000, okay, minus 12,000 minus 19,000 minus 140,000 minus 6,000. So what I can see 339,000. That is the revised net profit. So basically, we have been able to attempt a question on accounting bodies in West Africa, technician scheme. Okay, question 1. Okay, and then in the question we were able to correct errors. So it's a community of errors affecting the trial balance and errors not affecting the trial balance. And then from there we prepared the suspense account. And then from there we prepared the statement of revised net profit. So if you have questions, you can drop it in the comment section or reach me on the numbers displayed. I'll be there to reply you with the right answers. Thank you.